Good morning, everyone, or afternoon, depending on where you're where you're at. What I'm doing today is earlier last year in 2017, I did a series of seminars that were 20 hours in length. So what we're doing is we're rebroadcasting, or I'm representing some of these in a little more condensed format because 4 hours sitting listening to cost accounting is probably not the most exciting thing that you'd ever want to do. So we decided to cut this into 2 hours and really do it as a 4-part series, which we may consider, since we have more content possibly, listening to what you all might have to say, and maybe we'll tailor some of that content to some future seminar. Okay, so this is me. I've been in the industry for a long time, 30 plus years, and it's an industry I love, and I've been 15 years working with AX in many different capacities. Microsoft MVP, I was awarded that in 2017, and I was re-awarded for this year. Just so you know that we have to earn this award every year. We're voted on, and they decide whether or not they're going to keep us. I've been mostly in my career on the post-sale side. So what I have been doing virtually my whole career is delivering ERP implementations. I've got a number of successful ERP implementations, not all in AX. American Production Control Society, I was certified in the early 80s. So I'm actually a manufacturing consultant by trade, but I branched out to any number of different areas. So I'm a regular speaker at AXUG and been involved with the organization for a number of years. Part of my background around my career is I helped design ERP systems. And we were doing, at that point, what we felt was some fairly advanced stuff. We were working on a rate-based production system, and that you would part of the just-in-time movement, or it's now called lean. And also to go along with that, as any of you know lean, you also know that the way the costing system works, you may or may not like, but generally early on working with these areas. Frequent contributor to MS Dynamics World. Not only do I encourage you to join AXUG, but also take a look at MS Dynamics World. There's a wealth of information up there too. And one of my industry focuses is costing and the costing process itself. And I've been many times out either teaching cost accountants or working with companies on their costing problems. And part of our presentations is going to talk about costing problems and how you fix them. All right? Now, so here's our objectives today. I would gauge this session to be anywhere from a beginner to advanced, depending on where you're at. So there's going to be something here for everybody. In general, though, I'm going to give you the building blocks and why they're important and how you use them. And from there, there'll be some unique aspects that we're going to look at that do affect the costing system, and a lot of times they're not fully understood. So, and one other thing, I'm depending on how long we can leave the session open. I'm willing to stay and answer any questions you might have. I encourage questions during the presentation, but keep in mind too, we want the question to be pertinent to the topic I'm on, and also the fact we have a very short time frame to do a lot of information. Also, you can get my email, and if there's anything you want to send me or question after any of the sessions or between sessions, feel free to do that, because part of my responsibilities as a Microsoft MVP is to be responsive to the community and participate in the community. That's largely what we're selected for. All right, so we got the costing system and the impact of settings. A lot of times when people set up a costing system, that's the last time they look at it. Well, we're going to kind of go back through the costing setup and tell you what these settings do and what they mean, and it may reflect on something you're having an issue with you want to change. Then we're going to go through the basic operation. And what we're talking about that is how does the costing system work and how do the different costing types work? Because I think there's a lot of misunderstanding about these costing levels work actually, and we're going to cover that, and we're going to explain to you what you see, when you see it, and why you see it that way. Then we're going to talk about inventory recalculation and its effects, because let me illustrate. FIFO is a costing method, but it is a costing method that is created by an adjustment. Other than standard cost in what's called fixed cost, the system operates natively in weighted average date. The recalculation is what is done to adjust it into your FIFO or LIFO layers. We're going to cover that more in detail, but I want you to know that inventory recalculation and inventory close, which are covering a later section, very important to understand what they do, why they do it. And many people run the recalculation as a nightly job, depending on how intense and how many items you have. We're going to talk about the difference between physical versus financial inventory, because this is a concept that was new to me when I started working with AX. And we're going to go through and explain what the difference is. For all practical purposes, physical when you receive it, and financial is when you invoice it. And there's reason why it does that way. Last, we're going to review the effects of marking and how that works within the costing system. And I really believe we can maybe start on manufacturing theory, but quite frankly, that will be more the second, because this is, I doubt if we get to that subject today, but it will be carried forward into the next session, which is on standard costing. Any questions on the objectives at this point? Okay. Okay, costing system setup. One of the first things that we need to understand is how what's called the financial inventory parameter in your dimension structures changes how the costing system operates. This is, again, one of the most often things I've seen as a problem in the initial setup. So it's something I want to cover with you so you understand what the capabilities are. So for the first one, here's your storage dimension group. If you look here at your financial inventory, this flag's very important because you could have it cost down to the location level if you wanted to. Now, nobody will ever do that. Now, just so you know, or I wouldn't know anybody would do it by location, but just so you know, this flag is very important. You'll notice here it's at the site level, so it means that at the site level, and that is a required construct. And for those of you who understand site is a physical separation, it's a costing separation, and it's also a financial dimension. I can tie it to a financial dimension, and then also that flows into my ledger. But for this purposes, it's important to know that every site at a minimum, can carry and will carry its own cost. That is not undesirable because most of the time your acquisition costs are different from site to site. Obviously, when you've got standard cost, if you've got a number of sites, you still have to have a reflection of standard cost at every one of those sites. But I think that's the minimum. Now, obviously, most of the time you'll find it that is clicked on when I go to sites for the warehouse, because I think that's how it defaults, or that's how it used to. What that means, you would be carrying a different cost per warehouse. That may or may not be desired. But if the warehouse is turned on, and when you look at your systems, okay, it will, in fact, be carrying a separate cost per warehouse. Now, one other thing I didn't mention before, I want to mention now. everything I'm going to talk about, for the most part, applies to 2012, and for the most part will apply to different costing versions before 2012. I'll try to wherever identify where those differences are. And the only difference between this and 2012 and 2009 is the dimensional structures were grouped together. In 365, they're two separate independent elements, which quite honestly makes more sense. But so again, here's the storage dimension from the storage dimension groups. Now you also have the tracking dimensions, and this is another one that's important. You'll notice here that I have the flag turned on for batch number and serial number, or owner, I'm sorry, owner. What this means is that the cost now will be based on the batch. There are times when you want a cost per batch. And that's what this is telling us by looking at this, is that when we have a batch-enabled product, we're going to now cost per batch. Also, you'll notice you can cost by serial number. Where do we use it? Well, we use it a lot of times if we're dealing with variables of cost, depending on any number of different characteristics. I've seen it mostly on serial number, where we have, let's say, a configured item, or we want to capture the exact cost for an exact element. But just so you know, so you can do a costing now even at the batch level, or you always could. And by the way, this applies to all previous versions. Okay, so let's take a look at how this actually works. Now here we've got the financial inventory on the batch number cleared. And again, we're working in weighted average date at this point. So if we look here, the first transaction of 10 was at $120. The second transaction was at $150, and that was receipt 1 and receipt 2. It did a weighted average date of 135. So the average between those two batches. Now we have it selected. The batch number we issued was S002. With it selected, it carries a cost at S002, and it will take the $150 cost and apply it to the issue. So therefore, clearly showing you the impact of having that financial dimension turned on. And just so you know, I want to make people aware of it. I'm not advocating as much as saying, yes, you can do this. I've seen it more on serial numbers of very, very expensive items and configured items, because a lot of times the configured item has a part number, but architecturally, it can be a little bit different. But also keep in mind that usually a configured item is also marked, and we're going to cover marking later. But generally, it would be for serial number items that could vary in cost and value. Okay. Next, we're going to talk about item model group. And really, it's again to talk about the elements here. So we talked about the dimensional structures. Now, item model group, and also, by the way, item group, I don't think I'm covering is primarily the item group is structured to drive the inventory postings. The item model group defines the costing method. You'll see right here, it's weighted average date, right? It also supplies for include physical value or not. We're going to cover that later. The other thing, this was not, I don't think 2012 maybe did have its stock product, but clearly stock product was something that was not pre-2012. But you do have service items which acts differently. Think about this as a service item with, if you take stock product off, that can work a little bit different through the planning structure. Some reason why they did that, and I don't want to go into them here. But then you've got include physical value. We're going to cover that later, but here's an interesting one. Fixed receipt price. And here's where we can give you a correlation on why this exists from previous versions. if remember back to any of you who were around at 2009 or before, there was not really a standard cost. You had a checkbox that said standard cost. It wasn't an inventory model type. If you look at this fixed receipt price, all fixed receipt price is that same situation. When you click this, it acts like a standard cost. It doesn't act like the standard cost. You don't have all the benefits. But the reason why I believe they added this is so in migrating up from 2009, you could keep the same costing method while you were migrating, let's say, to a new standard cost. I think that's the only reason in there. I'm just suggesting to you, have it turned off because your system will work a lot different if it's turned on. Okay, and of course the ledger integration, which we're not here. So costing versions. Costing versions are very much misunderstood because you can have any number of different costing versions, and they can be for cost modeling, cost projections, any number you want to have, and you can have as many as you want for any number of different reasons. The key, though, is that you can only activate one cost at a time. Now, what you can do with these is many times you can set up a costing version, a planned cost costing version, and don't allow it to be activated. And it can be a way that you can model initial engineering cost for new products. So there's a lot of things you can do with them. But basically, it provides a framework under which you can carry a unique costing environment, but it's not necessarily associated to the costing system in the ledger. That gives you a lot of flexibility. Also, it's not unusual to create a costing version for every calendar year, particularly in standard cost, because it depends. A lot of people have different philosophies of standard costs. Some people set their standard costs for the year, and they may not recalculate the whole system until the following year. And there's a reason for this. We've based all of our profitability on assumption of cost. What we want to do is see how we're performing to that cost, because that impacts what we plan for our profitability. So many times people go with that methodology unless there's a significant change, and then many times they'll just do the, let's say, the roll-up or change to that item. We're also going to talk about on the production side the difference between the standard cost or the planned cost and the estimated cost, and why there can be differences there, because there can. It also depends on when you rolled it up and when you activate it is what it really boils down to. All right? Okay. By the way, Julie, when would I see any questions that would, where would I see that? I see the chat window. Is there a different window than the chat window?
Yeah, there's a question window that I can see, and you can stop and ask me, or not quite sure if I can make you see that as well.
No, if you'll let me know, that's even better.
I will let you know.
Okay, I can focus. Does everybody feel this is about the right level and the right speed? I mean, I can speed up, but I can't slow down too much. But but if everybody feels, I can move faster if we feel that's necessary.
Just put yes or no in the question box. Give Don some feedback on how this is going.
You know, it's very hard. The one thing I don't like about the webcast a lot of times is that you can't see the people. So you don't know. You don't have the visual feedback to say, am I moving too slow? You know. But in general, okay, let's go to the version types.
All right, we've got all kinds of people saying good speed. One person says a little on the slow side. So
yeah, and I feel a little on the slow side, but if the majority says good speed, that's fine. But yeah, I feel a little on the slow side. But again, I tend to be too quick. You know, get away. I got to speak slow enough to keep up with my thought process.
Yeah, the vast majority said good as is. So
okay. So now we talk about the costing version types. first one is planned cost. And let me explain some, and I think I probably covered this later, but planned cost is a cost inversion type that allows you to run this. And the only difference between planned cost and standard cost is you cannot activate a standard cost from a planned cost type. Activation means you're saying now, this is my new cost to the financial system, okay? So when we say activate, that's what that means. You cannot activate a standard cost from a planned cost. Planned cost has another capability that is in previous versions. That we got some other things in the new version now that we can utilize to solve some problems, and we'll cover those later. But generally, think about planned cost. You can also do a multi-level roll and a cost roll-up. And for those of you that may not be familiar with cost roll-up, we're going to cover it later. But think about a cost roll-up as going through the bill of materials or formula, depending on what manufacturing discipline you're using, and it rolls up from the bottom all the way through the top. So what it's doing is taking all of the current costs and applying them at the highest level in the bill of material. Whereas standard cost, you can use this costing version for all items, but you can only activate standard cost from a standard cost costing type. The other thing, and I'm going to cover it later, for most of the time and anything previous to 365, and so far I haven't proved it out in 365, but there's some new capabilities in cost roll-up that I'm just going to be evaluating and presenting. The effectiveness is that it's only single level. This is a limitation imposed by the system because it really doesn't want to roll through the whole system every time. So it made a full roll-up of the system fairly difficult in the standard cost environment because you pretty much had to roll every level up to get to the highest level. But think of it as that it's only single level, which only means it looks down to the first level of bill of materials, grabs the cost from there, and that's what it uses for a standard cost. So I just want to make sure that you understand the difference. And conversion is used when you're converting to the new standard cost from any other costing method, including fixed. So it provides for a way that you can take what's in process, and it creates a window of time, and then it will effectively have you finish anything that was started before, and it will accommodate everything was the middle, but it creates a cutoff that says now we'll convert everything to standard cost because we have now we've now accounted for the differences in the two costing method. And again, it's unique to itself. I don't want to go into great detail, but it's used for a cost conversion to the new standard cost. Okay, I think I've covered this, okay, but the limitation that you have is, again, what we said, you cannot activate a standard cost item. You can only activate a standard cost item from a standard cost type. From planned cost, you can either do it from a planned or standard cost if it's a planned cost item, which means it's another costing method, is really what it means. We talked about the single level roll-up. We talked about the multi-level roll-up. So that pretty much covers those considerations. So here's your costing version setup. Again, we've got what they're calling version 10. Usually we put the year or something like that in the costing type. So it's a standard cost costing type. It's for the current fiscal year. By the way, you can block, which means you can't do anything with it, or block activation. So that's kind of what I'm suggesting here. For right now, the only cost we can activate it from is this second one, is what we're seeing right here. Oh, I'm sorry. Block activation, we can both use this and activate it. I apologize. In this one, we cannot activate it. We can use it. We can start calculating and figuring out what the costs are going to be for the next year, but we cannot activate it. Again, just to reiterate, I want to make sure, because usually when you do this, no says you can use it, yes says you cannot use it. So it's kind of the opposite of the logic usually. All right, so when you get the version set up, you are going to, you can say valid for, and let me explain why you might want to do this. When I go to a new calendar year, I want to make sure I have continuity in my costing from day one. I may set it the from date to go to 1/1/2017 until I've got the new version of my costing stabilized. And then I may go ahead and turn that restriction off. You also can say, can I affect the cost price, the purchase price, or the default sales price? So you can have it so that you can have one just for cost, one just for purchase, one for just establishing a default sales price. So that's part of what we're trying to set up through those restrictions. And yeah, this is a cost price model. What you have here is, this is asking you, do I want to use the calculation group or the version cost price to determine how I'm calculating? All right. We're going to cover that a little bit more, but right now we'll use the version cost price in this calculation. And this is for defining a, it can calculate based on percentages a recommended list price. And this is part of what we're talking about. In the purchase price model, what it's saying, for purchase price, I'm going to use item purchase price. I'm using the version cost price, so it's going to look here. I'm going to show you the subtle difference between this and what's called the calculation group. I'm going to suggest you put together a calculation group because you have better control. And we'll cover that a little bit later. The other thing you'll notice that this is single level. You're not going to be changing that. You'll be able to change that if it's a standard costing version. You would on a plan cost. You could roll it up single level or multi-level. And then what you end up with is these elements which represent your cost that are active in your system. So when you activate it, it becomes an active price, and that's what the system will use from that point forward. And again, keep in mind, you can set the purchase price in here too, and that allows you to keep a history of purchase price deltas if you chose to. Okay? Julie, do we have any questions at this point?
We don't. Carry on.
Okay. Well, I must be doing a wonderful job.
You are.
So again, this is where you'd look at these active, and you can look at it right from the cost version itself. You can look at these active prices for all your items. That's where this view is actually coming from. All right. Now, calculation groups. Remember, we went back and we talked about you can use the costing version or the calculation group. The calculation groups have been around for a long time. I recommend the calculation groups because it really gives you more granularity and a way to identify and support certain, let's say, alarms or notices. It also has a primary and secondary source of item cost. So what that means is I could do something like, say, use the trade agreement price unless there's not a trade agreement, and then use the purchase price. So I can create at least a two-step hierarchy. It does describe how proposed sales price is arrived at. I don't know that many people using it, but some people will use it to say, look, we typically want a 20% margin. So when we calculate the cost of this new item, let me also give me something in the way of a target sales price. 20% would be on more in the distribution, the manufacturing, hopefully. But you understand what I'm saying there. And it can be configured properly to reduce errors, because what it does is it allows you to configure it to say, if I don't have this, give me an error, or don't give me if I don't have this. I'll give you an example. If I had a bill of material and for some reason we weren't using routings, and or there was a group of items we weren't using routings, I can turn off the fact that we need a routing or it gives us an alarm. And you're going to see that here in a second. So here's a calculation group, and this is an example. I usually set up two, one for purchased items, one for manufactured items. Now what I'm saying here, use the item purchase price first, and this is for cost roll-ups. I want to stress that. This is for cost roll-ups only. Because what happens if you don't have some representative price out there, that cost comes into the roll-up as zero. And then I'm saying in this case, use the item cost price, which is the cost of the item. You also can use the inventory value. There's a lot of different things you can use here, but in general, this says, this is what I want to look at first, and if it doesn't exist, get this. Use this one. I am working based on the cost group for the sales price model. And then here's my warnings. Well, for a purchase item, I might turn on if it has no cost price. But generally, you're not going to have bombs or routes or resources. Now the next one I'm going to do is a production. Yeah, I recommend you have one and you use this calculation group for all your production items. And then what you're going to use is the item cost price. And by the way, we're talking about non-standard cost items. If there is a standard cost, it is going to use it. All right? So we're saying, in this case, use the item cost price, which is the one that's the planned cost, and if not, use the inventory price. I could have turned them around. But for cost roll-ups, a lot of times people don't want to use the inventory price because the inventory maybe is wandering all over the place. It depends on how tight their costing system is. And we're going to cover that a little bit later also. But you can also see I'm turning on the warnings. If there's not a bomb, I want you to give me a warning. If there's not a route, in other words, if the route doesn't have resources, or you don't have any quantity you're consuming, or if you have no cost price on that item, give me a warning. So that I can identify those items that have a problem. By the way, it's my belief, or I've demonstrated, one of the best way to know that your item is set up with bombs and routings is to run a roll-up. That's why I want engineers to have access to the roll-up, but not access to activating. The reason why is that if it doesn't roll, which can happen, you got something set up wrong, you don't get an error, and the cost looks representative of what you expect, you're almost 100% of the time are going to be able to release that production order without it causing you an error. It's just a good overall check of that item setup, that production item setup. So the calculation group in this version is on the engineering tab, and it's right here. Now, in earlier versions, it's there. It's on all the earlier versions. I can't say specifically which tab it's on, but in D365, it's on the engineering tab. And then there also is a default calculation on the inventory and warehouse parameters. And that is right here. What it will do, it will use this one if there's not one at the item level. But very important to have, very important to facilitate, because when you roll it up, you want it to be representative of what that higher end cost is. And if you don't have a cost, if it can't pick up a cost at the lower level, that cost is going to flow in at zero. Cost groups. What a cost group is, and we're getting close. Yeah, I should be able to cover this before break time. Think about a cost group as an element. It's the basic element of your costing pieces. What it does is it says these are the elements of cost, and I can define those. And the types are direct materials. Think of that as materials. And again, these are in cost roll-up types of structures. There's direct manufacturing. Think of that as labor. Direct outsourcing, think of that as outside processes. And indirect, and think of that as an overhead calculation. So those are your definitions of your cost groups. So again, like I said, it's a basic building block for the costing structure. And again, it provides calculation of sales price. I have to throw that in. It's just, it doesn't necessarily, people a lot of times don't use it much, but it's involved in that. So here's an example here. You can have it undefined, by the way. I'm not sure what the benefit is to that, but you do have that one as a cost group. But you've got direct materials manufacturing, indirect, and that's your overhead calculations and direct outsourcing. Also, by the way, on a cost group, you can set it up. Let's say this was direct materials. You could set up a cost group that would be default, which means that, again, you set up the cost group at the item level, and there's other places on the labor side. If you don't have one set up in the item, it'll hit the default. You can obviously have only one default for each one of these types. And so here is a demo. They're showing you the cost group item assignment. And here's one of the most unused capabilities of the system. It's not enough to know it's a material cost. What if I wanted to know at a certain level what type of material it was? You can see that I have the ability through my costing system to subdivide these elements of cost into a grouping. So when I can look at a cost roll-up, I can say how much of this was hardware versus how much was electronics versus how much was something else. The fact is you do it through here, and it is, I think, a valuable thing to take a look at. Because what are packaging costs versus, those are the type of things you want to look at if they're part of your bill of material structures. So this gives you an idea on how you assign it to items. Okay, cost categories. It defines the cost category associates to the costing group. So think of the costing group as the element that costing uses. Cost category is the element that you assign to routings. So that this cost category equates to a costing group, which equates to a cost per hour, is what we're suggesting here. So that's how we do the linking on the labor side, and we're going to cover that. So, what you've got is the cost of labor associated with the production activities. That's what I covered. It is integrated at the routing level, and then each cost category is associated with a costing group. Okay? So it's, okay, we're going to go, let's take a look at, we should be able to finish this one. So here's your cost category to cost group association. Here's a cost category of assembly. That cost category would be associated to your router, to your routing. By the way, we also have cost categories in project, and there's a reason, one of the reasons why is so we can have the consumption link on projects. And I'm not going to go into it a great deal, I go into project, but But what it is in general is before we had the consumption version, you had to wait till the production order was done. And if you had a production order chain of multiple production orders to build something, you wouldn't hit the cost wouldn't hit the project till the end of the highest level. What we did is allowed you to post a cost in a lower level production order, provided that they were all linked together. So anybody that has both of those, but here's where we establish the cost price, and here's the cost group associated with. So that's how we do the linkage at the cost category level. This, by the way, is also where I recommend you put your ledger postings, because this is primarily managed by the finance or cost accounting group. The work centers are not. You can drive the posting from many different places. This is the one I recommend generally. All right, cost group labor assignment. All we're really saying here is that just showing you, here's all your cost groups. You can assign them to a cost category. That's all we're showing here. Okay, this would be a good time for break.
All right, great. Thanks, everyone. It is now 13 minutes to the hour. So let's start right again at the top of the hour. Whether that's 11 o'clock, 12 o'clock, 10 o'clock, 9 o'clock for you, we will start again at the top of the hour. So if you need to take a break now, we'll put ourselves on mute, and it's a good time to do that. Talk to you in a few minutes.
Yeah, okay, Julie, I'll just let me know when you're back.
I'll do that.
Okay, great.
All right, folks, we'll start again in a few minutes. So just reminding you, we got a couple questions in the queue if we want to answer those, Don, before we
Sure.
move on.
Sure. That'd be great. By the way, we started with 43. We still have 43, don't we?
We are, yes, we haven't lost a soul yet.
My goodness. And it is cost accounting, right?
It's very compelling. It's very compelling.
And by the way, this is the worst, the setups is always the driest. It is always the hardest, but you got to go through it. I mean, every module, like we always said the first day, if we could get people through the first day, we'll be good. So if we have all 43 and we've went through all that, I think that's wonderful because it gets a lot more interesting downstream when we're taught. But I'm basing a lot of this on other mistakes I've seen people make, and by assuming the setups are correct. And you got to have, it's the basis for how the thing operates. And I am enthusiastic about costing just because I think anything that you want to share with people, you need to be enthusiastic about. And I've done this for a lot of years, and it's interesting. To me, costing is fascinating. That's what, because there's so many possibilities you can do within it. And have worked with a number of broken costing systems, I know that there needs to be more, shared knowledge on what some of these problems are, and I cover that within this series too.
That's great. And I should remind folks while we're waiting for the top of the hour that we'll be doing these sessions again every 2 weeks through September. So, and they're all 2-hour sessions, building on the basis for cost accounting. So,
yeah. And the next session is on standard cost. I believe it'll also be manufacturing theory and standard cost, because we have to have a base. Because what happens if you just say standard cost, you're not accommodating all the other costing methods. So I don't think we're going to get to that. Remember, this is structured for a 4-hour session. That's why that last section, I'm not, it'll be moved over to the production. And, again, we also can take, after these 4 sessions, if there's a demand for more, we can take, I've got other content that we can do in a subsequent series of things. Okay? One of the things I want to get from the group is what else would they like to know? What are the other things that they have questions about? So maybe at the appropriate time we can ask them for those inputs too on what they're bringing.
Also, and when the session is completed, folks, you get a chance to complete a survey that also you can tell us what else you'd like to see, and both Don and I will get emails that contain that information so we can tailor your needs for the upcoming session.
I gotta tell you that I got a survey back that they said I was too chatty. And quite honestly, I'm a professional consultant, not necessarily a professional educator. Part of my responsibility is to tell anecdotes.
Yeah.
And also, I want to try to make it fun a little bit. And so I think I deliver a lot of content in between that.
Great. So
I don't get to tell as many anecdotes in this one.
Oh, I'm sorry. Didn't mean to interrupt.
Oh, no, that's fine.
I was going to say, let's get into the few questions that we had. And
yes, that'd be great.
Was from Mudia. And she asks, is cost accounting located under projects or production control module?
It depends, okay, on the version. First off, let's talk, and I'm glad you asked this question because there's huge confusion. In 365, and I'm just going to call it 365 because it takes too long to have that whole string of stuff. In 365, you've got a whole thing on, I think it's called cost management. It's not, there's a module called cost accounting. I want to cover that in a second. But think it's under cost management. In any version before that, most of it was in inventory management. with some being in production. And that was the same in 2009. What's in 365, they put everything in one place, which is kind of nice. Whereas you kind of look around for it in the other two. But if it's look under bill of materials in your inventory. A lot of it's under bill of materials in your 2012. Well, I can bring a system up here. Hold on. Yeah, I won't bring it on the screen, but let me just look here. Yeah, I can bring a D365. While I'm answering the question, I'll bring up another system. I can better clarify that. But let me talk about what is called cost accounting. Cost accounting is really not where any of the stuff I'm talking about is actually set up. Cost accounting really was something I think was mislabeled, in my opinion. It really has to do with a more elegant cost accrual type of mechanism. It's not widely used. I personally have never implemented it, and I've only ran across a couple companies that were actually using it. So if somebody's using it, I'd love to hear, how you're using it and what benefits you think you get out of it. But think of cost management, and I've got the 365 session up over here. And I was right. It was called cost management on 365. In pre-65 on 2012 and before, part of it was over in inventory management, and the other part, there was part of it you set up in the production module. Okay? And like I said, the cost accounting, which I believe has been around certainly 2012, and I think it was in 2009 also, it's not the same thing. It's just, they should have called it something different, in my way of thinking. Is anybody out there using it?
We'll see if we get any replies to that effect.
Okay. And did that cover the question?
She says understood. So
okay,
that was good.
Okay.
Next question's from Michael. He says, great first half. I feel like I'm in need of concrete examples to put these setup pieces together to be better able to understand everything.
We're absolutely going to do that.
Great.
Okay. Yeah, the part of the problem is that, as we talked about, Julie, I don't know who was on when we talked about it, this is the hardest part because we're talking about how you set it up. It is a required part, though, because if these are set up incorrectly, you get incorrect results. So part of the rest of it is going to be talking about the impact of these different things within the costing system. Like on the batch, we did show an example, a working example, when we looked at the cost on the batch. But in general, for the most part, you will have concrete examples on how it works and how it's working, because that's what's covered next after we cover all the setups. Okay?
Perfect. And then comment from Finn, who asks, it would be great to know where to find additional information, including training materials, hands-on labs, etc.
Mm-hmm. What I'll do is let me go through, and I have some. The previous versions were hard. Part of why, well, let me explain something. Part of why I did this class initially, or started doing it, because it was in multiple manuals. And somewhere I have a breakdown as to what manuals you need and those types of things. As far as doing other classes and things like that, I would say, talk to Julie or the AXUG. We can do any number of different classes, any number of different types of subject. There's a lot at Summit. I'm teaching, it's not a costing at Summit, but I'm teaching a project course, the training, and I'm teaching 4 hours of project, and I'm teaching 8 hours of WMS. So AXUG is one of your best sources of getting this information at, I would like to say, a reasonable price. Okay, this one is free because as I told Julie, I said anybody that's willing to sit through 8 hours of costing should get it for free. So,
Good point.
right,
All
so
right.
particularly, okay, so
That's all the
yeah, there's,
questions we have in the queue right now. So,
right. And the other thing, you can always reach out to me directly at Don Riggs at busproc.com, USPROC. I can help guide you, or if you have specific questions you want answered, or you can go into the AXUG portal and post questions there too. Okay. All right, we ready to roll?
we are.
Okay. Okay, so what we're covering next is going to be what's called the costing sheet. Okay, let's talk about, I like a little bit of the history because it differentiates so people know when things happen. So if you're previous to this, you're not going to have it. So the concept was introduced with AX 2009. So just so you know, if you're 2009 and forward, you've got the concept of a costing sheet. They added the capability of purchase orders in AX 2012, and I don't know what our version. I know it's in R3, I don't know before. Now you may say, well, why do we need a roll-up for purchase orders? Well, if you've ever want to incorporate your cost of acquisition, such as freight, into your standard cost, this gives you a vehicle to do that through a roll-up process that will now take that, let's say that freight, anticipated freight accrual type of thing that you want to show up in standard cost. Before that, we had to manually put it in there. With this, we have a way of doing it that it works very nicely. Also, before costing sheet, you really didn't have a way of doing overhead calculations. You had to, before 2009, you had to post it either as a separate cost, you had to do it as part of your labor component and break it out separately on the ledger, or some other creative way. But so it allowed you to have very advanced overhead calculations based on just about any element of cost. Another thing that it did, it allowed you to create the vision of how you wanted your costing system to work. Did you want to look at the different costing elements of like we talked about, the possibility of having maybe packaging costs versus production costs versus material costs versus hardware costs versus electronic costs? It allows you to find those buckets, custom buckets within your costing system. So whatever those elements that are important to you to understand, you can, as long as you can associate it to a material item or a cost item on the manufacturing side, you can make that a group, like assembly costs versus, let's say, stamping costs or something along those lines. The other thing too, and I don't know how many people are actually using this because it's really more used on the purchasing side, and not that many people know about the element on the purchasing side. I discovered it myself one day when I was just playing around back a couple years ago, and I don't think enough people know, but it also provides for a unit-based pricing. And what I mean by that is many people can say, my acquisition cost is so much per pound. Or I've seen it more pounds because I've worked a lot with chemical companies on the process manufacturing, and I use process manufacturing a lot because it has additional capabilities. But in general, a lot of times people can associate it to weight, depending on the nature of the product. The other thing people can do is equate it to size, because maybe it takes so much size in the truck, so you can kind of say, okay, it's so much per cube, so to speak. In my opinion, along with the introduction of a true standard cost system, which happened in 2009, along with it is one of the most significant improvements in the costing system because of the flexibility and power that gave us. Oh, got to get, there we go. So here's effectively just what it looks like. It starts with a grouping, but then you've got items which fall into the material cost groups. And keep in mind, remember on the items, we could have different material cost groups. It's got the production side in it. And that is, remember, we had the cost groups based on like assembly, those different types of cost groups there, so we can break that out there. And then it has a whole section for overhead. And then you could have associated cost group, which we have cost groups for overhead, then multiple indirect cost calculations. And again, before this didn't exist at all. So let's now go through some examples of what these look like. And by the way, this is in D365, but again, the same thing applies to 2012, and also it applies to 2009. The only thing it doesn't apply to 2009 is the section I'm going to do on the purchasing. So just standard in the demo, the cost of conversion is what we're talking about, is really manufacturing costs, is really what we're talking about. So what I can do now is I can define these groups. This is a total group. So what we're saying is we're going to total on material, and it's also a group header. What I'm identifying here are all the other cost categories that I have associated here. Keep in mind, it'll also give me an error if I miss one. So it will tell me, it'll allow me to do it without that cost group, but it will tell you that you didn't incorporate that. And here's my different labor categories I want to use. Pretty straightforward. I mean, we're really talking about defining the cost group, whether it's a material or whether it's labor, and then also uniquely able to identify what the packaging was on a given item. Then we get into the overhead calculations. And again, this part of the demo, it's saying machine depreciation is more of an allocation. But what it's saying is that, and it's trying to indicate to you that it also has output based. Normally, your machine depreciation is driven through your depreciation module, but you could calculate an overhead that represent a cost per unit. That's what I'm trying to point out here. You usually use it for tooling amortization or something like that, where we're going to say, I want to say, look, this tool life is for 250,000 pieces. I want to take a percentage of that tooling cost and incorporate it into my item cost. That's all we're really doing here. Don't like what the name they call it. It's really more machine amortization, in my opinion. But again, you get the idea. The other thing, you can also say this is a material overhead, and it's saying it's a percentage of cost for handling. Now, I'm not trying to suggest to you that that meets all of the criteria for it being included in the cost, because I've heard a lot of different things on we cannot incorporate our handling costs as part of our overall cost. But again, that's just an example. And then we also have another one here that's an indirect labor cost, which is a rate per processing time. So it's so much per hour is what we're saying. So it's just really some illustration of the different types of ways we can apply overhead. Again, before that, the other thing too I want to suggest, don't make your costing system so complex that you can't understand it. I've seen people come in here and have I'm trying to remember the record, but it was something like 500 or 600 different entries in this cost sheet. Simple is better. I believe in the maximum number of distributions you should have for any one item should be 15. But again, I mean, they had it down to the machine level and the tooling level. You know, we want it to be representative, but we don't want it to be so complex that nobody can use it. The guy that developed it couldn't understand it. So, and actually it was so complex that there was a bug in Microsoft we had to fix because it was running out of resources. Okay, now we're going to go to purchasing, because I want to talk about this because I want people to know that, particularly if you're standard cost or even if you're in actual cost methodology, if you want to, let's say, accrue for transportation, and and I'll get to that in a second, but I think you get the idea, is you can use this to also add like a freight accrual or maybe some kind of handling cost or something like that to get you more of a true acquisition cost. Having said that, it's important also to understand that this purchasing sheet, cost sheet, can also be applied on the purchase receiving side if you choose to. It can either be establishing of a cost or a planned cost or a standard cost, or it can be used to actually drive additional costs like a freight allocation. So if we look at the material then, what we're saying here, same kind of concept. We're breaking the material out into these different components. And then we're saying here is this is just a percentage of price is what we're using. And it does have different overhead calculations you can use, but I want to make sure we understand that that is incorporated in the plan cost and can be incorporated as part of your actual cost. So the other thing I want to mention, and this is just one, because I could spend probably an hour just on cost sheet. I want to make sure you're aware of the different types of cost, and this is more in the overhead. There's a total, which makes sense. There's a unit, or there's a cost group, which is the cost groups that you saw there, the different materials. A surcharge or unit base. So a surcharge is a percentage or cost per hour for the most part. And unit base is something, I'm not sure when they introduced it. Y'all have to look at 2012 because I don't recall it being, no, it was in 2012. I don't recall it being in 2009 because you didn't have the purchasing part of it. You're usually not going to use a unit base necessarily for finished goods, but you could. I mean, you could use it for finished goods to say, look, here's our cost to get it to our warehouse. So I'm trying to open up the ideas of the possibilities. You could say, look, it takes me from my manufacturing center to my my warehouse, it's about 10 cents a pound. And I could accrue that expense and add it to my value in inventory. And I'm just showing you some additional ways you can do that. You can either do it on a units-based costing sheet. You can do it by quantity, weight, or volume. And this is very powerful when you think about how most of the time I can equate on large volume items. I'm usually thinking about how much is it per pound to get it to the point in that site. Let me just cover a little bit about the allocation. One of the reasons why I recommend you use an allocation method for freight is if you are using common carrier a lot and you're not having the vendor charge you freight, which if you're doing a lot of freight, the vendor's going to make a markup on your freight. That's not exactly what you want to do. So if you're arranging for your own freight, there are some things in the WMS system that allow you, and I'm not using the proper terminology, in the transportation management system that allow you to group purchase orders coming in on the same load, but that's a lot of work. It's very hard to break out a common carrier invoice and equate it to the individual purchase orders because many times they're delivering more than one purchase order. One of the ways to do it is to do a freight allocation and have an account for the allocation and then an account for the actual freight in, and then you can able to see how effective your allocation is by comparing what you've allocated to what the actual was. Some people haven't even hit the same account, and they look at that as the freight that was not accumulated into the inventory. Okay? So this gives you an idea of what now this cost sheet looks like. So this is a price calculation, and here's my electronic components. Here's my cabinetry. Here's my miscellaneous components. There's my material cost. There's my packaging labor, assembly labor, quality labor, total labor, and then the different overhead factors you saw, which adds up to my complete cost. And this is actually coming right from a production order. And this is the estimated costing. And just so you know, what the estimated costing is the current bill of material structure. It does not mean it's the same thing as your standard cost. Reason why? Depends on when you activated it. You could have had a change to your bill of material. In other words, we don't stop making changes to our bill of materials just because we have a standard cost out there. We make changes to the bill of materials based on need, being more representative of what it truly costs you. I just want to make sure that they're two different things. Standard cost is when you roll it up, which will use the current bill of materials and routing structures. Estimation is based on the current bill of materials and routing. Make sense? All right. Basic operation of costing system and costing types. We're going to do through the costing system and talk about the different types of costing, how they work, and then how things like recalculation work with them. Okay, here is really all the different ways you can cost in AX. So you've got the standard cost, and that's really, I like to call it the new standard cost system. The fixed receipt price, that's the old standard cost system. We've got FIFO, LIFO, LIFO date, weighted average date, and something called moving average. Also, if anybody's using moving average, I'd like to know, this has been more associated, in my opinion, with retail, so I don't have a lot of background on it. I've never used it at this point because I thought it was more for retail and high volume, high moving of products. So I've never used it as a costing method with either a manufacturer or distributor. I think you'd be more likely to use it in a retail environment, is my understanding of it. But if anybody has any input on that, we're all here to learn, so let me know. So here, I'm just going to march through how the different methods work. And what we're talking about, I want to make sure we're talking about, is how the method ends up with, not necessarily how it gets there. Okay? So if we use FIFO first in and first out, what it's saying is that the first in, I'm going to grab that physical receipt. So in this case, I've got one, I ordered one, it came in at $10 because the FIFO layer, the first FIFO layer was $10. Okay. And this may be a rehash for some of you, but I think I'll tie it into how it actually does some of the stuff. Now, if this is LIFO, last in and first out. And what it's doing is, keep in mind, now look at here. I want to make sure you know the differentiate between LIFO and LIFO date and weighted average date, because they're just opposite of what most people think they are. What LIFO means is it's going to take the whole period, and whatever the last one is for the whole period, it's going to use that for its LIFO cost, even though this transaction occurred after this issue. So think of it, it looks at the whole period and say, okay, what was my last transaction for the period? Then it goes to the first issue and starts applying that cost till it consumes it. Then it goes to the next one. This is not usually what people necessarily want. Whereas we look at LIFO date, it is date sensitive so that it picks up the $20 one because that's the last receipt that occurred before the issue. That is more likely what people want. Weighted average. If we look here, our weighted average here is 1160. And again, it looked through the whole period and effectively added up all these and created an average from them and came up with a price of 1160, which is 6 plus 2 plus 2 with these costs. So let me ask the group, if this was weighted average date, what do you think that cost should have been. Yeah, Jill, if we don't get something, here, I'll just go ahead and share the secret.
So we've got $10, $11,
okay,
$12, another 10.
Well, $10 is the winner.
There you go.
And let me explain why. Think about it. We're in time. Now, let's assume, and maybe you were assuming before we had inventory before anybody that wasn't $10. But let's assume this is the first inventory transaction ever. This occurred at $10. What weighted average date this says is a running average based on a point in time. So this issue happened here, so therefore it's going to use the $10. If it happened here, it would have used $11. And it happened here, it would have used $11.60. Make sense? So what this means, what we've classically, or at least what I've classically called weighted average in previous systems, is actually weighted average date. And there's another thing that's really important. Other than standard cost and fixed price, the system uses weighted average date as its native calculation process. This is, by the way, usually if I recommend, if there's no other very strong feelings and they don't want standard cost, the best costing method is weighted average date from the standpoint of the system. Because every other than standard cost and fixed price, every other method other than weighted average date is an adjustment. And I'm going to show you how that works. So I'm going to talk about costs for a second, and I want us to think about purchasing. And here's the point I'm trying to make. The more we can get to our fully built up cost and reflect that into our inventory properly, the better and more realistic our costing system is. The purchase cost is only part of the cost. If you really think of a cost, the cost is everything, every cost from the beginning of when you know you need it to all the cost it takes you to get it to the point of use. That's what your true cost is. So the more you can reflect that into your cost of materials, the more accurate, or let's say, I think the better you're going to be able to associate in your costing system, provided they're realistic. If all of it drops to the bottom of below the line, you don't know on an item-by-item basis what the profitability is. You just know overall whether you're profitable or not. So therefore, the more you can get in a fully built up cost, in fact, I don't think I'm doing the session here, but I do a session up just on fully built up cost. How do you get there? What are some of the things you're doing to get there? So I just want you to remember that the purchasing cost is only part of the cost. So you should try to capture in some way, even if it's an allocation of it, these additional costs, and have them go into your ledger. And by the way, that should be part of your standard cost too. It's just that if you don't have it part of your standard cost, it would produce a variance. And that's a common problem, by the way. That's why they introduced that purchasing roll-up piece. Now let's look at what happens when you posted standard cost. When we do a PO receipt, the inventory is posted at standard cost. And really what it says, the offset is typically an accrual. So I'm going to debit inventory, I'm going to offset that to a purchase and accrual account. When I post the inventory, expenses are allocated if we have any of those expenses we talked about. And remember, we have other types of costs that can be applied at the line level that can then be allocated, and miscellaneous charges. I'm sure you're all familiar with miscellaneous charges, but one you may or may not be familiar with is those miscellaneous charges can offset two ledger accounts, or they can become part of your inventory costs, or they can be part of your liability. An example, if I have a freight charge on my vendor invoice, that freight charge is part of your obligation to pay, so it becomes part of the liability. But also, you may want that freight charge to be also become part of your cost of the item. You have those capabilities. And before all the elegance of this cost roll up, you would typically do that through miscellaneous charges, is how you would do that. Okay, so next, the inventory is posted at standard cost, whatever that is, and any difference between standard cost and total cost for that item goes to what's called a purchase price variance. For those of you know standard cost, many times there's a lot of people don't like standard cost, but part of it is they don't necessarily always understand all the concepts of it, and they look at it as tedious. I'll try to make a case for when you use standard cost and when you don't use standard cost, but most manufacturing environments would use standard cost. And the reason why is because they can manage by variance. It gives them a better idea on how good their standards are. Okay, but purchase price variance. So we post a variance. So really what we're saying is receive it, the item comes in a standard cost, and we hit a purchase price variance. I just wanted to get fancy with some of my drawings here is what we did, you know. So now here's purchase order costing, not standard cost, and also fixed price. Okay, posted at purchase order cost. So whatever's on the purchase order gets posted to on the PO receipt. Offset again as a purchasing accrual. Expenses are allocated and inventory is posted at actual cost. So if the expenses are allocated, that becomes part of your inventory cost. And really what we're saying here is received, physical inventory cost is at PO cost, and financial inventory is at the vendor invoice cost. So when we post it physically, it's whatever is the PO cost. When we post it financially, though, it'll incorporate those miscellaneous charges allocations. They don't occur until the vendor invoice. Now we're going to talk about some of the things that I've worked on fixing costing systems that I want you to kind of consider. One of the things that's kind of interesting is how we look at costing systems. And you know, some people look at standard costs and say that's maintenance intensive. And they look at average cost system as a self-maintaining. It's not true. It's not true, because some of the things you've got to think about to maintain a healthy costing system is you really need to have a planned cost to have something to compare against. And I'm going to give you some illustrations on why you want to have a planned cost in a non-standard cost environment, which operates kind of like a standard cost, but it's more for comparative. And this one happens all the time. The thing you must understand that in a non-standard cost system, if there's no inventory, there's no cost. In an absence of an item cost, the system will use a planned cost. And if that doesn't exist, the transaction will be posted at no cost. Let me illustrate. How many times well, again, I get this all the time. Somebody decided they didn't like their costs, so they cycle counted all their inventory out, and they cycle counted it then all back in, and it came in at zero cost. Happens all the time. And the reason why, or they'll cycle count it out and it came back in at a different cost. So let me illustrate what the problem is. As soon as you have no inventory, you have no cost. If you have a planned cost, it'll use it. If you don't have a planned cost, it'll come back in at zero. So there is a very strong reason why you want a planned cost. Because if there's no inventory you try to transact against it, it uses a cost of zero. And the one I just told you is the most vivid illustration of that. The other thing that planned cost does in a non-standard cost system is it gives you an element like a standard cost system, and you have something to compare against. You have reports that allow you to say, give me all inventory transactions that were outside a variance percentage against my planned cost. Again, in a non-standard in a non-standard cost system, you really don't get variance that helps you identify a process that occurred that was wrong, that obviously or looks wrong based on, because you have nothing to compare it against unless you have a planned cost. See, in a standard cost system, if you make a $20,000 mistake, it'll show up as variance.
Hey, Don?
Yeah.
We got a quick question that's kind of relative to what you're talking about. So
perfect.
Yeah, it's from Michael, and he asks, isn't planned cost called managed cost in 2012?
No. Again, he may be, I don't disagree with him that it's the same thing. And it could be, again, I don't know where it's from. It might be called different in a different country. It could have been a customization, but no, it's clearly called planned cost in 2012 in the U.S. English version.
Okay.
But it's for all practical purposes exactly the same thing.
All right. Gotcha.
Exactly the same thing.
Thank you.
So, because it is a cost you're trying to manage to. Okay. I mean, think about it. If I have a planned cost, at least I have a comparative basis that I can compare all my transactions to. Another reason why you want a planned cost. Again, the other thing is for cost roll-ups. Remember that if you don't have a cost, the cost roll-up will pick it up as zero. And many times on a new item, think about it, a new item doesn't have inventory. It's imperative to have a planned cost and configure your calculation group to pick up your planned cost so it doesn't pick that up as zero. The other thing too is I like to suggest to you, just like standard cost, if we're projecting profitability, somebody's basing that on some kind of cost. And I'm suggesting that planned cost is a good way to start and build up your profitability level above there and then manage the actual cost to see what that variability is on our assumption of profitability. And the other reason, and I'm going to cover this a little bit more later, but planned cost will create a situation where you have less adjustments. And when we get into the recalculation problem, you think about it, I'll give you an example. Would be a good example. Again, if you transact at zero and then you fix it, you're going to get a big recalculation. So let's say if it's received at zero and then the purchase order comes in and it's $100, you've got this big recalculation process. In some cases, it will use planned cost to do its transaction. And even more important, if you're getting a lot of variability, it also is a good indication as to you've got a problem with that. The whole idea of adjustments and on your recalculation process, you want to minimize them. We're going to get more in that in detail, but here's what the key is. If you transact a cost incorrectly, let's say on the plan or on the purchase order receipt side, let's say they put the purchase order in at zero, and you transact against that, let's say you sell it, Now that's a zero cost of goods sold. What the closing and recalculation will do will fix that. So let's say downstream the vendor invoice comes in and now it's $100. Well, if you never run the recalculation and closing process, that cost of goods sold will never be fixed. But the other thing that's true too is you run that in a different period, that cost of goods sold will hit in a different period. We're going to cover more of that later, but I just want you to know that that's one of the other reasons. Okay, so what's the best costing method? You want to, I don't know how many times I've been in companies where we've got different people that want different costing methods. And my role as a consultant is to recommend, but recommend based on the advantages or disadvantages. Obviously, that's a kind of an interesting position to be in because many times people feel very strongly about their costing. My belief is that any costing method can be effective as long as you understand what it takes for it to be effective. But here's some of the misconceptions. To me, to make any costing method work correctly, it takes the same amount of work. You do not save time by not using standard cost. You don't use standard cost because you want to value your inventory to be more representative of actual cost, not a standard cost. It's a whole different thought process. In one, you're trying to manage cost, and the other one, you're managing by variance. You're saying this is what it should cost. Now, why didn't it cost? And the other one, it says this is what it cost. Both concepts and constructs are valid. Again, if a company's highly distribution oriented, and I think you can throw retail in here also. Keep in mind, I'm not a retail consultant, so I've worked with point of sale systems, but on AX, I'm focused on manufacturing and distribution companies mainly. But they tend to use a non-standard costing method because, again, they also have a volatility many times of cost. Particularly you get into people that are doing commodities, okay? Manufacturing companies tend to use standard costing. And let's qualify though what that means though. The more intense the manufacturing process, the more likely you are to use standard costing. Let's say if you're a chemical company and primarily doing blending, you could go either way, right? Because we might argue that a lot of that business is distribution, and most of the manufacturing really is more of a blending process. And so the value add is in the formulations, not necessarily in the labor component and managing those labor components. But as long as we understand, we're just saying some basic guidelines. For manufacturing companies, it has some very, very big direct benefits because not only do I have a variance, I can easily tell that it occurred, I can tell what caused it, and then I can work on either improving the process or changing the standards. I think we said standard cost identifies costing errors much easier. $20,000 error will show us a $20,000 variance. Somebody will look at that, okay? And then I kind of just saying that if you're not going to use standard cost, the best costing method is weighted average date, which is typically a like weighted average, because that's how it operates natively. Everything else is based on a calculation. And let me tell you, and again, I've got one anecdote I can use here. I've worked on many costing system problems. So one of the things I ask first off is, what costing method are you using? And they'll proudly say, we're using FIFO. Then I'll ask them, how often do you run recalculation or do an inventory close? They'll say, what's that? They have never been on FIFO costing in the life of that company. It's because it is an adjustment. You have to run those processes. And in certain processes we're using that costing level, we actually did a recalculation every night because that's how we got it into our FIFO layers, is through that recalculation. Okay, so now we're going to go into how that recalculation actually works. Are we on time? Okay. Okay. So what it does is it adjusts the inventory to get it in the correct costing method, other than weighted average date and standard. It makes adjustments to timing of financially costed items. And let me explain. If I finance, we're going to go through the financial versus physical, but just so you know, when I receive it, I'm receiving the purchase, what's on the purchase order. When I get the vendor invoice, that may or may not be the same value. And also, it also could have incorporated other associated costs. The more difference between the physical and financial inventory transaction cost, the more likely you are to do through the recalculation and closing processes adjustment to such things as cost of goods sold. And we talk about that in a little more detail. The other thing, prior to 2012, it had also provided the revaluation of the on-hand standard cost, because it didn't have in 2009 a posting when you actually did a change of standard cost. AX 2012 and Forward does. So it actually writes the ledger adjustment at the time the cost change is made. Most systems I had would do that before. So basic cost elements in AX. Receipt cost set by user. And all we're saying here is when we receive some, oh, sorry about that. When we receive something, that's set by some element like the purchase orders, things like that. So here's the point. If you think about any costing method, it's not on the receipt that the costing adjustment is made, it's on the issue. I receive it at whatever that cost is, right? Whatever that is, I receive it at that. I may average it into the costing or do something else with it once it goes in the inventory, but the receipt cost, whether it's production, whether it's purchasing, whatever the other, that is a cost. So if I say, what is my actual cost on that transaction, I can look at that transaction and say, that's the actual cost for that item. The issue costs then are using the costing method to automatically make the cost based on the related method. And really, what the system does, and the exceptions are fixed receipt price and standard cost and weighted average date. And that's the same thing as a running average. If you look at in AX, any transaction that occurred before the recalculation, that's just a running average, is all it really is at that point. And again, I've been saying that for day one, so I don't need to belabor that point, but recalculation gets it in your different layers. So now we have an example, okay? So here's a purchase order receipt. And what we've done here is that we're saying we're receiving 10 at 10, 10 at 20, 10 at 30. Then I'm going to sales order, I'm going to buy 10, buy 10, and buy 10. Now in FIFO, the first one I'd sell would be the first one, the second would be the second one, the third would be the third, right? So in theory, when I buy the first one, it should come in at 10, this should come in at 20. You get where I'm going with it. So here's the transactions before the recalculation. Now keep in mind that I have, if you remember, I had a percentage of overhead. So this was 100, but it added 825. This is the 200 add to 1650. So you get where these numbers are coming from. So here's the actual purchases. Here's your 100, 200, and 300. That's what posted on the sales order. What's that? The average. So I want to illustrate nothing, and you can do this on your test system. You can see exactly what I'm talking about. So again, it does it at weighted average date is what it's using. Now, come along and I do my recalculation. I'm doing it for the current period. I'm just doing it for the item number. So I'm doing what's called the recalculation. The recalculation does what's called settlements, which is an adjustment. And you'll notice what's interesting here. Well, it's an adjustment of 108.25 positive and 108.25 negative, which is pretty significant because if we add 108, you can see what happens if you subtract 108 from the 216 or whatever it was, which nets you now, bang. Now you're in FIFO. So this happens through the recalculation. There's something that's important you need to understand, though. It will adjust your transactions within the system so that they will reflect the right number. I'm going to show you that next. But the ledger postings can occur at different times. That's one of the reasons why it's very important to do the recalculations on a regular basis, because you're less likely to get the adjustments between it once you do the recalculation. But let me show you what it does at the transactional level. Okay. Oh, sorry about that. What it did, it made an adjustment to minus 108, which effectively meant that it made this at the 300, well, 324 is what it ended up doing. That's fairly complex. Are there any questions currently, Julie, on any of these?
Nope, we don't have any questions in the queue right now.
Okay. So we'll move ahead. One of the strange concepts I had was physical versus financial. I know we're up against the time, and but again, we'll just continue on some of this. We can also continue on for a while, or I can answer any questions people have. Physical versus financial. In AX, there's a separation that is not the same as in other systems. And so let me explain what that means. When you think physical inventory, think of a purchase receipt. Think of a sales order packing slip. On a manufacturing order, think a report is finished. When you think of financial inventory, that's when I've vouchered the vendor invoice. That's when I've processed the customer invoice. And that's when I've done a manufacturing order, I've ended the process. That's what those two differentiations are. And they're treated as two separate classes of inventory. Sometimes they have a different ledger number. Okay, here's one thing. I'll just cover this one real quick. We have time. Here's the include physical value flag. Also, by the way, I identified a bug in version 8. So I'll explain that to you. This says I want to include physical value or not include physical value in my costing. So if I have a running average price and I got it off, it's the financial cost divided by the total posted quantity. Okay, and to illustrate that, you'll notice that I have no physical cost amount here. Oh, cost when, yeah, the flag is off. So my cost is 2165, and that's the division of 20 into, or no, it's the physical receipt, which is 10. Okay, let me go back to that. I've got 10 that's been financial received, 20 totally. So what that means is it's going to use 10 to calculate the cost price. So it's going to take the amount. So that previous screen is wrong. I'll have to go back and fix that. It's going to take the financial inventory that it has divided by the financial cost amount, and that will give you a cost price that's calculated, okay? Now, if I look here, if I include physical value, it's going to take the financial cost plus the physical cost and add the total posted quantity and the total received quantity. And that should give you the new cost price. I want to show you this in 2012. This doesn't happen. I want you to know that it calculated across. I'm going to report this bug into AX, and they may already have a fix for it. But if you're on version 8 of D365 F&O, I identified this price, this bug, just while I was preparing for this. This should have been 216 plus 152 divided by, in this case, 20, I think, totally. But you can see it should have affected the price, the cost price. And what was interesting here, it's worse than that. It even passed the cost price on to a sales order. So this bug, I just want you to know that this is a bug, but generally that cost price on the sales order should have been the combination of both, but could be adjusted if there's a delta of it going between physical and financial, okay? So here's when to use it, is you shouldn't use it if you don't have planned costs, and you shouldn't use it if you use poor purchasing practices. You know, people that put a purchase order as a placeholder for 0 because they don't know what the cost is, and they forget to do it, and now all of a sudden it comes in at 0. I don't want to average that 0 into my cost because it's just going to make a bigger adjustment. And the point I want to make is that it will fix the difference between the physical and the financial cost, but that's through the recalculation. But if you've got good system design, and you've got good, and that means including planned cost, and you've got good purchasing practices, do it, because it makes sense to average that in to the cost, because that's what it's going to transact at until it gets the financial cost of that very specific segment of inventory.
Don, it's Julie. Now, just a note that we're at 2 minutes to time. So.
Yes. So why don't we do this? I mean, is there any opportunity to continue on for a little while, or do we want to go ahead and just add this on to some of the next sessions?
How long do you think before you would finish?
Oh, it's not very long. Yeah, it's just this. That's it.
15 minutes?
Yeah. Oh, yeah. Yeah.
All right, let's continue on then, folks.
If you don't mind, anybody has to leave, of course.
Off, you can always watch it on the recording. Yeah.
Right. So part of the things too, I get involved a lot is problem with reconciliation of the ledger. And through this, I've identified a number of reasons why this happens. And let me explain what it is. And you know, most of the time it's set up. It usually isn't any system like this. So the first thing is, a lot of times people will make the physical inventory transaction a different ledger account than the financial inventory. All this really means is you got to add the two accounts together to tie that to many of your cost reports. So I want to make people aware of that. Look at your postings to make sure you know how it's posting the physical part, which means in the purchase order it would be the received portion. The received portion, many times people will set up an account that might say received but not invoiced or something like that. Well, that's an inventory account, and you need to consider that in your reconciliation. That's the only point I'm trying to make there, is make sure you've got all the inventory accounts considered. A big one, service items not set up correctly. Here's what happens. They set up a service item. They tie it to an item group that is an inventory item group. So what happens? They receive the service item against inventory account. How many service items do you think are and your physical or your financial inventory verification sheets you get. There absolutely is none. So you have a ledger impact with nothing going into inventory. All your service items, make sure you have service categories for them, and you use them when setting up service items. And this is the same for those non-physical type inventory transactions. They should be hitting expense. In other words, the service item should be expensed at the point in time you get it, or at least the expense accrued. It should never, ever hit an inventory account. Okay? Inventory accounts that have not been financially closed. You can have products that received and never invoiced and staying out there for 10 years. Well, guess what? They don't go away. And that's one of your biggest problems with these things. You got to fix the stuff hanging out there. And not just for planning, but also for costing. And of course, you've got the problems with an initial installation. I can't tell you how many times where I've went to a system where they're having trouble, and it was when they converted it from the old system. The ledger didn't balance in the old system, or the inventory values were different from the ledger. So the best practice is to, if you're bringing up a new system, use the previous period for the inventory balance, make any adjustments you need to make in your first live period, and go through your due diligence to understand what the impact's going to be to your financial system, which you could pretty much do readily. The other one, too, is the improper handling of the AP accrual. What you need to do if you're converting from another system, you should have 2 AP accrual accounts. One for the old system, one for the new system. And so if you get a vendor invoice against a purchase order that's not in the new system, you offset to the old AP accrual account. And this is another thing. The AP accrual is just way out of whack because they just move the balance over. There's no way to relieve that balance if you don't do something like this. So timing issues for physical versus financial. And just so again, we covered this, so I'm not going to spend a lot of time. Purchase order received at $10, item sold and invoiced at a cost of goods at $10, end of period, vendor invoice is processed, adjustment of cost of goods for $2 difference. So I want you to know that you want to make sure you try to close all of your purchase orders in the current month if you can, which is hard to do. You know, in other words, you may or may not have the vendor invoice, but you want to try to make sure as much of that as vouchers as possible. And you should, it's worse than with manufacturing orders, but you should be able to control that. All production orders should be closed at the end of the period, before the end of the period. It's really that simple. And what happens is that if you don't do this and you don't end these, that cost of goods sold adjustment could occur in a different period because it doesn't forget about it. It just puts it in the period it's at. That's not wrong. It's just you need to be aware of the timing of these events. Review effects of marking. I don't know how many people know about marking and what it does, but what marking does is it bypasses the costing system. Okay? Again, it bypasses the costing system. So it's tying a demand order to a supply order, and it's bringing in the implicit cost. And marking is the most overused and biggest headache that many people have. Your planning system, when you do release, it defaults to a marking. You want to make sure you take that off. You don't want to mark. Marking should be used in very specific. It should be something you apply for a specific situation. I'll give you an example where marking makes sense. I got an emergency order for one piece. I've got to pay a very high cost for that one piece to get it on a priority. It makes sense to mark that purchase order to the sales order, one, so nobody takes it, and also the other advantage, it doesn't flow through my costing system. That very high now gets averaged into my cost. There are other times, like it's used a lot on project. And again, that's why I'm saying it should be used in isolated case, and also it cannot be used, so you have to defeat the marking and defeat the reservation to be able to use it. So a lot of people get tied up with this marking when they try to use it someplace else. Okay, so here's the example. Got a purchase order for $40 per unit. Got a sales order for $60. So I'm selling it maybe at a higher price than I usually do, but it's just for one unit. Here's the marking. The sales order is marked to that specific purchase order. And that's a process you can do at the sales order line level. You can do that marking to the purchase order. What happens then, you'll notice here, looking at all these purchase orders, it actually picked up on the sales order that cost coming from that specific purchase order, okay? Bypassing my costing. So I want to make sure, because a lot of times people are not aware of costing or marking and what it actually does. How's that? So that's what I had down for covering today. So what we'll do next time is start up with manufacturing costing and standard cost. Okay? Questions?
Great. Thank you so much, Don. That was.
What time is it? Hey, only 7 minutes. We started 7 minutes late.
I know. Well, the first comment is from Jeannie, and she says, "Excellent job, Don."
Well, thanks.
Yeah, you know, Jeannie. Anybody else? Another one from Tony. Awesome presentation. No questions. Thank you very much. This was interesting. Oh, but we do have a question from Daniel. When using standard costs, are there any cost implications when marking?
Yeah, again, let me do some additional testing. I do not believe that marking works with standard cost. Because remember, your costing is always at standard. So your marking would tie that. Here's what I'm going to suggest to you. And I'll go ahead and prove it out. And I know I should know this, but sometimes I know it for sure and bet my life on it. This is not one, but here's what I believe you're going to see. You're going to see a tying to the purchase order, in this case we just had, where nobody else can use it, but it should transact all at standard cost, and you're still going to produce a variance. So in the case, you would actually produce a variance. The variance would never hit the downstream sales order, because remember, it's transacting at standard cost, but it would do the association that would not allow anybody else to take it. Okay? And I'll double check that, but standard cost will always transact as standard cost.
He says, so okay, thank you very much.
You usually have to say that's an exception. One thing I'd like to ask the group to do, too, is I think we've got a lot, and you can kind of look at the next sessions coming up, but give us some ideas of any questions you might have, any things you want to get covered in this or subsequent sessions, or any interest you have in any other types of materials along these subject areas, because we develop for you. We want to help teach you. Part of it is we want to make sure we're getting you what you need. I mean, I can do it enthusiastically, but I also want to make sure I'm giving you what you need. And also, I promise you, this will be the most boring day of the group. So if you thought this was interesting, it gets better, because we're more on transactional type stuff, which is always more interesting.
Right. We do have one more question from Lydia. And he says, great presentation. I'm newer to the system, so I hope this question's not too simple. No question is too simple.
No.
Anyway, the terms you use like BOM, bill of materials, standard cost, plan cost, cost roll-up, FIFO, LIFO, etc., are these terms synonymous to all ERPs or just for Dynamics?
No, they're synonymous with all ERPs. Now, here's how much I want to also make another statement. First off, a lot of this terminology came from APEX, American Production Inventory Control Society, which is one of the founders of creating the theory and funding the books for the theory. So you start with APEX terminology. So one of the things you might invest in is an APEX dictionary. What I'm suggesting to you, though, is for the most parts, these terms are synonymous with all ERP systems. Sometimes the AX usage of the element, though, is incorrect. And let me illustrate. We have this concept of, in planning, called, there's a difference between a release and a firming. And they use some of these things in the wrong context. But in general, in the costing systems, you've pretty much got standard terminology. So if you're looking at cost accounting systems, those types of things, these are the kind of terms they're going to use. You'll find some differences, like to differentiate in the process manufacturing systems, they're using more like a recipe. See, I'm at this age where I know the word, but it doesn't come to the surface. But they're using formulas rather than bill of materials, okay, is what I'm saying, just in the terminology. But from the costing construct, we all typically think of those as bill of materials. So bill of materials, a list of materials you need to produce something. Its hierarchy is multiple level because I might need to manufacture 3 items to ultimately figure out one, but they're all treated like separate items within our planning and our costing systems, with like the singular the moldy roll-ups we talked about. Routings are typically called routings in any system, and they're basically the steps of manufacturing. So it's the who, what, when, and how much of production. It needs to go here. We need to do this. It's going to take this long at this much cost per hour is what the routing provides to us. And then overhead is a calculation that is to cover all your indirect costs. It might be for space. It might be electricity, where I'm trying to allocate those costs into my fully functioning good. And there's a lot of discussion around overhead and the application of overhead. Okay?
All right. Thank you very much. That is all we have for today. So I want to thank you all for hanging with us. I think we did a good job keeping them on the phone down.
Yeah.
And we will talk with you all again in a couple weeks. Have a great week, everybody.
Hey,
Goodbye.
looking forward to it.